Welcome back to Trend Following Trading Ideologues, everyone. Hope you've had a good week. It's good to be back. Nice here in Florida. Finally got our warm temperatures back. I'm more in multiple layers when it's in the 50s and 60s here. So not today, just maybe a couple of layers today. So been a good week. Got a good weekend planned. I'm going to talk some trend following today. I'm going to remind everybody to keep the monologues to a minute or two. If I mute your mic, you can come back and then, and let other people in as well. Let's let everybody try to get as many people talking as possible. Richard's not with us today, so we'll have a lot of opportunity for other people to talk. Hopefully we'll get him back next week. A lot of good topics this week on the Twitter. So I encourage you to continue reading Twitter and getting involved in those conversations and talking about them when we meet on Friday. I forgot what I was going to say. Anyways, you see, I copied trend following trading ideologues from a group of guys who were talking in a podcast with Mark R. from TTU. You know, Mark from TTU. I can't pronounce his last name, but they were talking about trend following about a month or two ago, and they started calling me, kind of me. Maybe they didn't even mention my name, but ideologues, because we're hesitant to branch out into adding different features to our trend following, and then they call themselves the pragmatist. So I have been invited to be on that podcast next month. So I've got to clean up my act, behave, be a gentleman, and these are really great guys, and they're super smart, and they know all about trend following. So it should be kind of interesting to see if I can kind of keep it together and be nice. So they gave me this ideologues thing, which I really like. And, other people have made fun of me too, and I adopted what they said as well. If you look at my Twitter description bio up at the top there, so someone called trend following cheap and obsolete. So I definitely adopted that. Rob called it ideologically pure, meaningless labels. I love that. So I'm going to keep that one as well. And then someone on Twitter, I couldn't find it the other day, called my systems Tinker Toy Hobby Level Systems. I loved it. I mean, I think that's just so funny. So be careful if you're making fun of me and it's too funny and it's too good, I'm going to have to adopt it. Because, we're all here to have fun, enjoy each other, debate and argue a little bit, but honest debate. You got to pay attention. Everybody has to pay attention to the facts, including me. My favorite tweet this week was this debate about, it's just ongoing. It's never going to end. We're beating dead horses as it relates to fast trend following is worse than longer term trend following, but CTAs may want to consider shorter term trend following because it helps with being part of crisis alpha for stock sell-offs more and better and quicker than longer term trend following. Just going to get short the S&P quicker in other markets, even though, it's probably not going to work and it's going to make your performance worse. So that really strikes a nerve with me that we should all sacrifice our business, our wealth for more assets and suck up to people who want to allocate a small percentage to CTAs because not because it's the perfect portfolio, which it is, but because of how it might help their dysfunctional stock and bond portfolio that's long only. Okay, although it's not
Oh,
ready.
yes, I'm ready right now. I have, Jerry, I have it's a traditional technical issue. And, I know it's so traditional that I really love this technical issue as a part of our trading, foreign trading ideologies, because I love all in this, all elements. And it's begun to be an element, my traditional program issue in the beginning. So I'm very happy to be here. I'm also traditionally in the beautiful place near the mountains, forest, and sea. Very nice weather here, but I like all kinds of weather. Maybe most, not all, but most of weather I like because of the nature. I love nature, and so very interesting. I was waiting these discussions. So nothing new. I was waiting this discussion for a week, every day. So, and very happy that this our trend following trading ideologies discussion is starting. And I want to say that Mark's surname is Mark Zebrzynski, so I can pronounce it, Mark Zebrzynski. Very interesting guy, Mark Zebrzynski.
So it took a Russian friend to teach me how to pronounce it, but maybe his name is Russian. I don't know.
No, he's Polish, Poland. He's in Poland, but in Russia, a lot of people who have Polish background, they have another pronounce here, another pronounce of their surnames, last names in Russia because of Russian language, but it's maybe a little similar. So for me, it's easier to understand to pronounce his surname than maybe for a person whose native language is English. I think so. It's a linguistic issue, I think. So, Mark Zebrzynski.
Good morning, Moritz. What's on your mind today?
Good morning. Hope everybody's doing well. Not much on my mind. Well, a couple of things. So let me correct that. But first of all, trading wise, still sluggish, still a little bit down for the year. Nothing major. This morning when I had a look at the markets, it could be an update, but let's see what happens. One of the things that I brought up, and maybe that is stimulating some thoughts or potentially good discussion for this group, is around stops and trailing stops in particular. So let's just use an example where you enter a long position. Say you enter crude oil at a level of 60, and then crude oil starts moving higher to say 120, so it doubles, and you have a trailing stop. And the trailing stop is ATR based, so it trails behind, let's just say, the last closing price by a certain number of ATRs. Now, what happens in that example is that because WTI moves higher, it tends to have larger moves, a larger range on a daily basis. It's just a bigger market now, which means that the distance from the closing price to the stop tends to increase over time, simply as a function of the ATR becoming larger as the market moves higher. So you have that correlation, if you will. Now, the opposite happens with short positions, right? So they move down. It goes from 60 to 30, to use the same crude oil example. You have the trailing stop, same number of ATRs trailing. Now the ATR of crude oil becomes smaller because the market is down at 30 and no longer at 60, which means you're a little bit tighter. You have a lesser distance between the close and your stop. And I have my thoughts on that. I have my answers to that, but I thought that maybe this is interesting for this group to spin around some ideas or have a debate about it. I'm not sure if we're all on the same page with that. So the question is, what do you think? Is this a right way of doing it? Could it be done better? Do you think it's problematic that the stop becomes tighter on the downside with short positions and wider on the upside with long positions? Do you think there could be a point that one could make that, the longer you're in a position, so the longer the trade duration, the wider your stop should get, so the position gets a little bit more breathing room, these type of things. I'm not sure if you've discussed that before. If you haven't, great, then we can do this today. If you have, then also great. It's going to be a little bit shorter today. But that was something that that came to mind that I wanted to put forward here.
I think that stop must not. I like the idea of Jerry that stop must be, of course, based on an average true range, and it must not be far from the price. It must not be very close to price. It's statistically, it's better to have wider stop than tighter stop. So, of course, we must understand that there is common sense in this. There is math, not common sense. First of all, math. And so here's my point.
Yeah, I think this is called chandelier exits. And I first heard about them from Blackstone, Eric Crittenden's old firm. And I think they still use it, 15 ATR chandelier exit. I think Richard uses things like this. Well, number one, I don't really like using the ATR in this particular way. I don't think it's optimal. It really, breakouts are so much more anxiety producing because you don't have that certainty of locking in profit. It doesn't, every time you make a new high with a moving average or with a chandelier, you're locking in a little bit of profit more than likely. So that is kind of rubs me the wrong way. We should seek out anxiety, and this is what breakouts give us. I'm sure they're going to, I'm pretty sure they would test that a bit better. One of the things that I've noticed, I know I have this debate with Absolute as well. I don't think it's a given that the ATRs get smaller in a downtrend and larger in an uptrend. It seems they definitely get larger in an uptrend on balance. But I've been noticing recently that anytime stocks make a new low, the volatility goes way up. And now maybe if the stock kept going for 6 months or a year, it would all of a sudden slow down. But the market rallies, the vol goes down. Anyways, but I don't really care about that aspect of it necessarily. But the thing that bothers me most about it is almost everyone who uses this type of exit, they put a feature in there that the exit cannot go lower than it was yesterday. So it's not always 15 ATRs from the high. If the ATR starts expanding and today's exit would be lower than yesterday's exit, that's no go. You can't do that. They put a floor on it that you can never have it go lower than, kind of like a breakout. It can never go lower than it was in the previous day. And they want to put that feature in as well. And I think that really creates a problem with changing the rules. And so you're changing the rules and not applying a consistent, constant rule. So the computer is going to penalize you for that. And you're introducing some non-robust ideas. Let it fly. Let it go. If you want to give it 15 ATR and then the ATR starts expanding and your trailing stop now becomes further away than it was the day before, go for it. But no. No one wants to do that because they love this feature, which is locking in profit. I don't like it.
Hi, Jerry. Hi, everyone. Regarding this question from Moritz, I tried to implement it once. Actually, my first systems, I had this chandelier exit. At some time, I learned from Jerry and the guys that simpler things should be better. And then I switched to the old classic breakout exit. What what I like about breakout systems is that they are so simple, so robust, that you achieve good results with fewer rules. So when I had my chandelier exits, I had to have a double rule for exit. One would be the give back on an ATR basis, and the other one was if a new entry breakout on the opposite side would be triggered, so that uh, let me give a concrete example. Suppose I get long on a 100-day breakout, and I exit from that 15 ATR give back, as Jerry just gave us the example. So if the price goes against me, and it's not enough to trigger that 15 ATR rule, but it's a new but it's a 100-day breakout to the downside, I should be getting short. So that's a double rule, not a single rule. So if we have a breakout exit that suppose we get in with the 100-day breakout and get out with a, I don't know, 70-day breakout, and then I have only one rule to exit, and that has value to me because the system is simpler this way. And commenting on the point that Jerry made, that the new level of the exit on the chandelier exit is never lower than the previous one. Yeah, it makes things messy because then you have a new parameter that's changing during your trade. That's the rolling ATR, the moving ATR. So what I did, a way to fix this is just like I use the initial ATR to set my stop, I would use the initial ATR to use this rolling, this trailing exit, this chandelier exit. But the thing is, as Jerry once told me in this space actually, that the problem is that the initial ATR doesn't mean much after 6 months that you're into the trade. So that initial ATR that you're using as your trailing stop is not exactly informative of what's going on. And what I found is that I had to put trading stops that are much larger, because otherwise I would be exiting and getting in and getting back in again, because at some point in time my trading stop would be too tight because I was using that initial ATR.
Yeah, I don't think using the initial ATR is a good idea. Or I don't think Maritz's question was more like using the current ATR, a multiple of that. And, I just think that trying to button things down too tightly is just something we all want to do. And we want to show progress and not have a big trade turn into a loss. And that's exactly what can happen if you only use moving averages or breakouts. And I think you're going to get rewarded on that. It's very counterintuitive and perverse that if you've got to like put your hands behind your back. Oh, there was this question this week on Twitter about what directed towards trend followers. What do you see as the major problem with the S&P, or buy and hold the S&P? And someone said something like, I just want to be in control. I don't want to just sit there and watch and not be able to do something and stop that risk, stop that drawdown. And I was thinking, that's to some degree, that's where you're going to get success. You've got to sit there and just follow the system and act like you're helpless. And that's why the S&P does so well. It is almost impossible to sit through those drawdowns. Thus, when you do, you've been rewarded. You see how I threw in been rewarded? You see how I threw that in there? So, and with trend following in the same way, to a large degree, we do have our trailing stops and our stop losses, but really we're supposed to act very helpless until that trailing stop, that breakout, that's pretty far away, because as that study I quoted said, longer term, medium to long term trend following works better than short term. So we need to put ourselves in a situation where we can give back a lot of profit on the current trades by following the best systems and the best parameters. And you're going to get rewarded for that. But if you want to button it all down and make it really smooth and very contained and not be embarrassed by a certain trade, then you're going to get something less, I believe.
I do agree. It is so difficult to make a system difficult on you because you want it to feel good naturally, and a lot of the success that hopefully we have is because we've come to the point where we can allow ourselves to make things incredibly difficult and sometimes painful, and not take the easy way out and stick to the basic rules, which we've discovered. And I fully subscribe to the fact that with our trading systems, the more difficult it feels to do the trade, the weirder it feels, the better it usually is. And I would also do this for the exits. So find exits which are kind of like tough, entries which are tough, exits which are tough. So tough that you think, well, I shouldn't be giving back all that profit. Make it tough. Stay in the trade a little longer, and I think you'll be rewarded for it.
I want to say that it's a great philosophy because even Niels said this in one of the series of top traders on the blog, that Fidelity had a research where they looked on the accounts which is the most successful ones, and the most successful accounts, the most successful traders were the traders who have forgotten about their accounts. So this ability to, like Neil said, doing nothing is doing something. It's a great ability but you must understand what are you doing. So when we are investing in SP 500, I think it's a bad idea because we don't understand what is going on. In fact, only narrative, only story, even if we look at a historical chart, it doesn't look very good. But in our strategy, as I always say, we have a logic behind this strategy. We understand what we do, and we understand that we are paying the price by waiting by this. We put ourselves in a situation where we are most profitable, and of course we are paying the price. We must be emotional, not evolved emotionally in this, not involved emotionally in this so much, and this is the point.
So just to pick up on what Moritz was saying, I agree totally. And because look, we're trading these systems because the computer told us they're the best ones to trade. So we're not like saying, hey, go out and trade something that's not that great or not even know what you're trading, what the backtest would say, and then just seek out pain and suffering, which I think is probably a pretty good idea. But we're also have in our back pocket, this was the systems that we chose. And then once we did our backtest and the computer told us we should trade medium to long term, we need to dig deeper. Let's dig deeper. Let's dig deeper into those numbers. Why dig deeper? We already know this is how we should trade. And no. We can do better. Let's dig deeper. And then we start uncovering the good and the bad. But the good outweighs the bad tremendously. No. We still want to dig deep, look into it, and maybe get rid of some of the bad so the good becomes even gooder. And there's what all starts going wrong, and that's, I think, part of the complaint, we would have, that I'm all for anything, the whole thing. Anytime I think I look at something and an option to add something to my trend following, it all just comes back to it's not these random ideas or this devotion. I think as we're trying to implicate that, the ideologues, they ignore evidence. Not at all. we see the evidence, we see the back tests. What we're worried about is the robustness of that, and is it worth uh, reducing some of our drawdown and volatility for adding more features and more parameters and possibly reducing the robustness of the trade. So it's all about that, not about not wanting to improve or adapt. Markets change. You have to adapt a bit.
Hi,
Jerry,
guys.
hi. Sorry. Go ahead.
So just quickly, I wanted to mention that, I mean, we've talked about we're going to be rewarded if we actually have a exit that is farther away. So this means that we will give more room, these running profits, to go back and become losses, right? So this is, we're going to be rewarded in terms of the mathematical expectancy of the systems that we are running, so which is fair enough. But we're not going to be rewarded at all aspects of life. So we're going to be rewarded fine. We have a better system. But what about what is happening emotionally is we're going to end up with a lot of dopamine. Okay, so the dopamine activity is basically the anticipation of the reward. So the brain at that moment is in the anticipation of reward. Yeah. So we are looking into those shiny greens. We are making more money. Oh, good. Today is making money. Next week is making money. And then it is all crashing out. And then so if the expected reward is achieved, fine. So there is no major obstacle for the brain. But if the reward is less than anticipated, then you're going to end up in stress, and you will possibly look for the immediate next activity. So you will be much more prone to addictive cycle, and you will need to manage the brain that engages with uncertainty. So it's actually, I definitely agree with what has been said, but it's just, it will be, so you need to manage your system and you need to manage the brain and that dopamine rush. And when it crashes and when the, cortisol comes into place, so what are you doing to manage that as well? So I guess my point is it is easier said than done, and you will be rewarded, but not all aspects of life. Thanks.
I agree, and I think that is very important. I think two things. One is it really, for many reasons, the way to trade is just to code it up and give it to someone else to trade for you, and don't look at it on a daily basis and don't question it and go away. We want to treat trading like golf. You get out there and maybe it is like golf and you get tortured mentally. I don't play golf, but I'm sure that if I did and I was poor, it would really bother me to keep going out there. And I think, but we've bought into systematic trading and we can computerize it all. The next logical step is never to have these conversations about how hard it is to do, and creating systems that choosing suboptimal systems because they make us feel better than the optimal systems. I mean, that's absurd. And we should just farm it out to other people to do. And I think over the year, and I remember watching that TV show Billions, and one of the main characters, a real life person who I've met before, Denise. She was played by this woman who was the psychiatrist for the hedge fund, and she had the prominent role. I mean, maybe the second most important role in the company. And the hedge fund, had realized how important. I mean, I know it's TV, but they realized how important it was to have this person available, because trading is such a psychologically tough game, and this was totally ignored in my career. Although when I went to work in the Turtle program, that Rich would say, "Okay, I want you guys to take a week off, like every month or every 2 months, just take a week off." So I agree totally, recognizing this issue, but it needs to be overcome, And don't trade. If you're not settled, if you're not suited to trade, then don't do it. Don't ruin your life. But it seems that if you adopt systematic approaches that can be coded, that there is some solutions there.
And I want to say that I have said before that we pay the price, and I have said before that if we go to the coffee shop and we pay €1 or $1 for this, it's okay. We pay the price, and our drawdown, our discipline, all these elements of our trading is our price for success, and it's normal. And why must we feel much pain about it? Of course, we're all humans, and of course, we have these maybe qualities, but we must understand what we are doing and understand that we are paying that price and we are getting rewarded for this. And I love this process. For me personally, I love this process. So overcoming myself, maybe. I love this for many years. So I don't have this problem now, and I'm very happy because of it.
Really quick, we have a great deal on the agents we have on our dopamine system. We can derive pleasure from doing the right thing. If you convince yourself that what you're doing is the right thing, that it's going to reward you financially, then you can have some you can extract some joy from there. And another thing that for me personally helps a lot is this very space, talking to people with like-minded people about these topics that are usually so alien to most of the people around us is really helpful.
Uh, yeah, you said, thank you. You said, Jerry, that the S&P was a great system because it was hard to be there when the drawdown comes. And what the academy world and the economic world in general did about giving the manage of your money to third parties, like you said, because you said give your system to another guy, and let that other guy execute it. And so, isn't that what the academia and the governments and everybody did for index funds? And so, like, index funds now are the best way. I'm just being a devil advocate here, but the best way to execute that, because when you were in the 50s or 60s or 70s, you had to decide to invest in an index fund or some kind because they didn't exist. But now you don't have to do anything. They just take money from your paycheck and they invest it and they manage it. And what I'm afraid or I see is that they don't uh, make any reaction to drawdowns because they keep investing there, and so it's like kind of a perfect system in terms that there's no emotion there because it's managed by people who never change their portfolio because they found a perfect system, and on top of that, everybody is in the same misery when the bad times come. So isn't that like a perfection of the way this works to get out your emotions out of your psyche?
Well, they definitely changed their portfolio. And it's a poor system. I think it's pretty poor in this, but sticking with it and with those principles has proven that as long as stocks keep going up and we keep having sell-offs that soon after the sell-off the stocks go right back to the highs again. It has sticking with that and not paying too much attention to it. Don't look at your statement. You can still redeem. Buying into it as sort of a religion that you really believe in. This buy and hold and buying the dips and indexing. I think these are all positive things. But it does depend on the market continuing to go up. There are probably people around the world who have the same mentality but live in different countries, and it hasn't been so kind to them. They've done the exact same thing. They believe the same things, but maybe I think the S&P is probably somewhat unique in that how well it's done. Now, I think you could have that same experience if you believe in trend following, invest in my fund. I mean, I'll take care of it for you. Just don't look at your statement that often. Don't redeem. it goes right back to the quality of what's going on, and the quality of the S&P is decent. It's not anything that I think this was one of my comments was the S&P rules are not anything that I think any professional researcher or backtester would adopt. It's pretty bad. It's not good trend following. There may be some sort of elements of trend following in there, but it's not the type of trend following that any CTA would probably adopt. They're free to do it. They're free to own the S&P. I don't know many who do as a permanent investment or who trade that particular way. But I just thought of something. A lot of this does depend upon our pride. It's not just losing money. It's that I'm not looking that great. I'm not looking as good as Moritz. Damn it, relatively speaking, I'm kind of sucking wind. And so, yeah, I'm losing money, but it's also my jealousy or the competition with other people. So maybe like what could happen is I'll give Moritz my system. He can trade my system. He can give me his. I'll trade his system. And I'm not going to really override the system. I don't really care enough about Moritz's system. It's not mine. I'm glad he's got a good one. I'm glad it's making money. But if it has these drawdowns, I don't care. I'll just do the next trade, right? So there's a part of it, obviously, that is about the money, and losing 10 or 20%, that's no fun. And, you're really going to have anxiety. But a lot of it for me, honestly, has been relative performance. Why am I in last place? Why is so-and-so doing better than me? And then what kind of flows through my brain when I'm doing better than everyone else? Oh, God, I'm on top of the world, but you're only up 10%. So what? I'm number one. And I think all of these psychological things feed into it. And it is good to recognize it and to have these sessions to talk about it. But I think Bruno hit the nail on the head. I can't believe I forgot about this. And that is, how did you do today? The answer for a systematic trader is, I give myself an A+ because I did all the trades I was supposed to do. I did none of the trades I wasn't supposed to do. I followed my system. And that's how you give yourself an A+. And we were told when we went there in 1983 that if you follow the rules and lose money, that's okay. If you make money by not following the rules, you might be in trouble. And that's exactly the opposite feedback you get from clients. I don't care what you do. Cheat, get out of your profits quicker, let a small loss turn into a bigger loss, as long as it's going to come back and eventually make money. Do whatever you need to do to make me money. And then what we're telling ourselves, follow these rules, follow the process, and everything will work out in the long run. Not today, not this month, maybe not this year, but in the long run, this is all these systems could ever promise, and we can't really rely on them meeting their promises ultimately because it's just an approximation of what might happen.
And sorry, what you said about envy, and I think that one of the great things that the index fund has for it is that when you look to your left, to your right, when you're on a drawdown, everybody else is on the drawdown too, and so you don't feel that bad. Like Buffett says that when you see that your neighbor that is dumber than you has a better car than you, that's when you feel really, really bad in life, in general for humans. So I think that the product has that for it. And there's always an internal discussion with my team about that. Is it the same to lose when everybody's losing or not? And some people say that it's the same, and some people say no, it's not the same. If everybody's losing, you don't feel as bad. And then regarding what you said about that you don't know many people investing as the index world, I agree with you. When you see the weight that each country has on the world market cap, and you see the pension funds, etc., for each of the countries and how they invest, they always invest more money on their own country because it's what they know more. So I agree that it's not something that is fully deployed. It's not an idea that's fully deployed, but the idea to have a third party investing for you, which is a committee backed up by the academia, etc., is pretty powerful. I prefer every day to execute trend following for myself, but I know what sometimes I'm more and more concerned about how these things are run by people who don't have skin in the game. So
Hello, Jerry. Space started strong today, and some very good points from the speakers. My system is similar to Bruno's. But I want to say, I always say that if you give the same trend following system to 100 people, you will get a normal distribution of returns, 100 different returns. And now, as far as giving the system to someone else, when I started in 1991, I was in fixed income, and someone asked me to back test a trend following system. I knew nothing about futures trading. I was in fixed income analytics, bonds, and stuff like that. And I tested the system, and we thought it was good, and we put down like $200,000 and traded and made 60% in 9 months. And my friend thought that was a good return to trade other people money, and I didn't want to do that, so I quit. And he gave the system to someone to trade it. Now that person had a technician, and at some point the technician got sick, and the new person that came in forgot to roll over the contracts, and they got all those false signals, and they lost a lot of money. That's what I want to say for now. I have a question for you later.
Moritz, do you want to get back to your topic? Did you even comment on all the stuff we said about the ATR exit?
I don't think I commented. I'm actually opening up my tools here. I remember that when I ran a comparison of systems identical or as identical as I could make them, so same markets, same entry rule based on breakouts, same initial stop, and then one uses the chandelier exit, which is the trailing ATR, and the other one uses essentially a new high or a new low to get out of the position. As I've said, I think the new high and the new low to kick you out of a position, that type of exit is a bit harder on you, and hence the preference. I need to run it again. My memory is that they did about the same in terms of returns, or performance, risk adjusted returns, whatever measure you want to use. I mean, there wasn't a big difference. So I don't want to criticize people that use trailing ATRs as an exit. I think it's fine. It's good. It controls your risk. And some people like myself, we have a different preference, and we make it a little bit more brutal. But it's more that fine tuning, I think. Now, another good thing about the high and low exit is that the issue of thinking about my question goes away, right? It's because it just doesn't apply. The ATR doesn't play a role anymore in the exit. You're just using the raw price, which, here you go. This is an argument, right? You're just using the single most important input parameter that exists, which is price, and you're not using a derivative of price. Like a moving average is a derivative of price. An ATR is essentially a derivative of price. So here we go. It's clean, simple, as simple as you can make it, and usually that is what I opt for, and what I do. But yeah, look, so you don't have to think about this ATR problem with wider exit distance on long positions, and potentially a smaller exit position or exit distance on short position, even though I agree with what Jerry said. Sometimes, or maybe sometimes the wrong word, oftentimes on the downside, you still have high volatility, right? I mean, that is where the markets get wobbly, and therefore the distance between your closing price and that ATR based stop isn't actually that narrow. It tends to stay relatively wide. Now the answer to this, like, statistically, if you wanted to find an answer to that, you could say, well, I don't really care, because I look at my system only in ATR and risk terms, so in ATR and R terms, and therefore it's perfectly fine for the stop distance to become narrow on the downside, because I measure everything in ATRs, and that's the only thing that counts for me, and vice versa on the upside. For like traders like us, where we use the highs and the lows as an exit, that question doesn't even pop up.
Yeah, and I think the most important thing about these exits, I mean, if it, is that they are consistent. You're consistently applying these rules, and so I don't really care about an exit, certainly from anyone else. But even if you just are consistently applying the same rule, that's the most important thing. Don't change that rule based upon distance to the stop, the amount of profit you have in it. However, these changing the rules can creep into your system, and this is what happens if you have this chandelier exit and you override the multiple of ATRs one day by saying, oh, it's lower than it was yesterday, assuming the long. So I'm going to say no longer am I multiplying that same multiple times the ATR, 15 ATR, no, because the ATR is expanding and I don't want to give back more money. And if the ATR keeps expanding, you can see how it could get out of control. 100 ATR profit could turn into a loss because your ATR is just going crazy. And 15 times the ATR is it's further away than the 300-day low. It's mind-boggling. So you can't do that. So this is changing the exit. You have changed it. You can tell yourself you haven't. It's the same code. You've got bad code in there, bad thinking. You can't make those changes. You have to get out the same way every single time.
Jerry, ATR trading stops or percent of profit? Have you thought of this?
Well, I've already said I don't like ATR trailing stops. ATR stop loss is good, right? Now, someone can tell me. I remember back in 1984 or 85, Bill saying, we're going to use this ATR stop loss, but ATRs have an artifact in them. The ATR calculation. So maybe I didn't know what that meant. I still don't. Maybe it's what Moritz was saying, that it's not pure price; it's an average. And then using percentages with continuous data is a no-go. You can't use percentage of the price if you're using continuous data. And frankly, I've never tested. I did come up with a way to create. So I didn't do it for this reason, to use percentages, but I did come up with a way to convert the data, continuous contract data, into an index to where it was 99.9% the same thing. And then with this index approach, you could use percentages, but I didn't do it for that reason, and I never tested percentages. And I've never heard anyone who has. Al, you're awfully quiet.
Hello. I mean, this month is I'm a little negative, but as you know, I just needed to the trading going is possibly a little slow. The bonds and everything else, and I was just thinking, so one of the things, for the people that I don't know, I trade hourly bars with the trend following way. All right. So I'm not a long-term trend trader. I trade the hourly bars, and one of the advantages of trading hourly bars is you go with the main trend. So when the long-term traders are long USD Japanese yen, you are also long. But when it turns, when the trend switches, if you don't put any filter on, of course, what happens is you're gonna be short that thing, and so this gives you more opportunities to explore, and that's why I was hoping that maybe my loss this month is going to be a little lower than just running a pure trend strategy. But that's where I am at the moment. So I'm waiting to see how the month is going to, and it's definitely not going to be one of the best trend following months, obviously, but we'll see where we'll end. Thanks.
Hi, Jerry. Hi, everybody. Yeah, I'd like to comment on a few things. Excellent discussions. I was enjoying listening. And as usual, when I listen for too long, I should write things down to say, so because I keep forgetting them. But so on the point of saying that you should deliberately pick something that's difficult to trade and follow, meaning that one should embrace volatility and drawdowns because it's very uncomfortable and most people won't stand it. So basically, you're saying that your edge is psychological because you can take the pain and you know that it's the pain that you take is your edge against the other people who cannot take the pain, and your edge is basically your ability to masochistically withstand a superhuman amount of pain, and that puts you in the 5% of winners, and the 95% of winners who are just normal humans that cannot take the pain are the losers. I mean, that's how I understand the argument. So basically, and going with that argument, and even as Maurice suggested, you would even go to deliberately pick something that's painful as a part of your strategy. So you're basically looking at, okay, what's going to hurt me more? Okay, this hurts me more. I'm going to use that. I'm not going to use the thing that's hurting me less or makes me feel better, because the more pain I make myself feel, the further away I move myself from average humans, and the bigger my edge.
I think that's right.
Okay, so
I think it is. It is one
you,
one component of it, and
I
I'm
love
not
how
sure. I'm not sure which one is the largest. So people say trend following works because there is a diffusion in and a delay in kind of like the dissemination of price information, and people react delayed, and the markets don't jump to the efficient and fair level right away. It takes a while for the information to kind of like trickle into the market, and then prices react, and that gives us trend followers on different time frames enough time to pick up. That's one reason. Okay, fine. I find that very difficult to prove. I can understand it. What's right and wrong about it, I don't know, but sounds logical. Okay, fine. Second point is that the world is autocorrelated, and that trends exist because the economies that we live in, they expand and contract, and they do this in cycles, and these cycles are then grounded in central bank policy with rate setting cycles, which, as you can observe now with the Fed and all the major central banks, with the exception maybe of the BOJ, once they start rising rates, they start rising rates. It's not kind of like zigzagging. It's like it's going up, then it's going down. So that causes autocorrelation in the economy and essentially in everything we do. And then thirdly, it is said that trend following works because of a behavioral element. To me, this is the one that, I mean, I can understand the cycle theory, but I can feel the behavioral thing. And, when you speak to people, and this includes, friends and people at cocktail parties and what they do with their portfolios, I mean, You just read the newspapers. People love realizing profits. It is so tempting to click on the mouse and get the money and feel good, and also then think about what that money can buy you. I've just realized a $10,000 profit on whatever type of trade. So what am I going to do with that? I'm going to, I don't know, buy a new Paladin bike or whatever. I give myself this goodie. It just feels so good. And when the loss shows up, then you kind of like hide in the corner and switch the light off. You don't tell anybody about it because it's so painful. And this asymmetry, this kind of like misbehavior, really, this bad trading behavior, is something that we trend followers can and do exploit. And I think this is where a big part of our money is. And when you think about this, then make it hard. Then I think it is kind of logical to put the finger in the wound, which other people's maybe self-inflict upon themselves, and go there, go to where the pain is, because that's where the money is. That's the corner where they're hiding in the dark, and that's where the money is. But you have to stealth yourself, because you need to be the weird guy. You need to be the weird person at the cocktail party, and you need to be a professional loser. You're getting kicked all the time, or most of the time, and every once in a while you get the reward for it. I really think that is the key reason. And these are there's so many things that are non-quantifiable. We're always talking about things that statistically, ideally, with our systems, we can quantify. Sample size and exits and ATRs, and it's all numbers and it's all systems. What we cannot quantify, and I guess that's a good thing, and that's probably also why it's work, is why is it actually working? People try quantifying the size of the CTA industry. Ask 2 people, you will get 2 different numbers. Ask 5 people, you will get 5 different numbers. It's impossible to answer, in my opinion. Give it a rough guesstimate. Okay, it's interesting, but I think it's impossible to answer because not everybody is reporting their AUM. I'm not reporting my AUM to any database. All the pension funds which internalized CTA trend following trend systems, they're not reporting to any database. Even if they are reporting, you don't know what notional trading level they trade. They could be very leveraged. They could be, have very low leverage. All of that impacts the size of the so-called CTA industry a lot. All of that impacts liquidity a lot. All of that impacts our share of open interest a lot. And there's no clear answer. I'm not sure what our footprint is. And so final thing, I'm mentioning different things here. It's kind of like when people say on podcasts and that the CTA industry is so large, and that kind of like everybody should have CTA exposure in their portfolio. I was like, yes, yeah, that's fine. I think that's great. That's a great starting point, or have trend and nothing else, or only very little else. But if everybody had trend following and nothing else, I know we're it's not realistic, but then our strategy is dead. And that I think is also logical. So it's kind of like, be a little bit careful what you wish for. I don't have any problem reading in the news that the CTA industry has, in aggregate, lost some assets, or became smaller, or that the strategy is no longer on vogue, and that clients don't like it. Yeah, that's fine. It's okay. Probably that means that it's not so crowded, and if it's not that crowded, then we can make more money. If everybody's doing this and everybody is kind of like to their eyeballs in trend, and some people say that they would like to see that happen, it's kind of like everybody should have trend. Yeah, I kind of understand. I'm not mad at having listening to this. It's well intended, but the consequence is you shoot yourself in the foot.
2 things. The reason trend following works is because price series in financial markets are non-stationary, and the duration and magnitude of the trends are random variables. And those who are consistent in dealing with non-stationarity are the winners. This is a very painful style, trend following, and this is why it hasn't eclipsed, because the attrition rate is too high. There is all these years of testing, I have learned one thing. There is a trade-off between the win rate and the stops, the exits. And you can cut your losses very short, but that will decrease your win rate. The pain goes up exponentially when your win rate falls from 30% to 15%, and most people quit. And this is the reason this is hard, and it will always exist because of non-stationarity and the pain to be successful. That's my opinion after so many years.
Sorry, one question to make one small question. Isn't the same for the S&P, for the index fund? Isn't non-stationary and has a lot of pain that you have to endure? Isn't that the same thing that's running under that system, so to speak?
Yeah, but when S&P, goes down, everybody goes down. Yeah. So, but in our case, when I'm watching the trend following space, so yeah, I mean, some people on their tweets are talking about 10% drawdowns. I don't have any objectives of achieving maximum 10% drawdowns. My drawdowns could be as high as 30% or maybe higher at times. So when Moritz was talking about the meeting the expectations, so to be able to make a successful business out of it is this, if everyone else wants a 10% drawdown budget, and if the right thing is, of course, to be able to have more CAGR, to be able to have no volatility management, higher drawdowns. So there is so the space, the total, there won't be many people who would be willing to do that. But if you believe in what you do, like I do, I think you're just going to take it at the face value, and do not I do not have any when I read other funds who are providing 10% drawdowns, I just move on. It is possible to code that, because my code is fungible, so I can just add 1,000 or two more thousand lines, and I can start doing volatility management just like on the back of it. But it's just I choose not to, because so this means that we're gonna trade what we believe in. So I believe in having larger drawdowns. I believe in following the trends to the end, and this means that it will be painful. So this means perhaps that I will never ever expect to have a huge business, and maybe potentially this will have consequences, and that's why I see myself first as a trader, and the people who are aiming for these 10% drawdown budgets, where they are trying to get these 100 million allocations, I think so their business is to provide a service, and I believe this is two different mentality and looking into the things. So this is how I see it. Thanks.
Many funds are providing drawdown levels based on monthly data, and this is deceptive. When you are talking about drawdowns, are you talking about maximum intraday drawdowns or drawdowns? Yeah, maximum intraday. It's impossible with trend following futures. It's impossible.
But if what they are doing is they are doing what they're volatility managing it, So it is reducing the drawdowns when you volatile to manage it, and then they're adding strategy number 2, strategy number 3, strategy number 4, and then you ended up with a lower drawdown, right? So that's what they do. This is what they believed in, basically. So that's, when Boris was talking about different clients. So this is what I understand, and of course Jerry knows this best. But there is a distinction between doing what you believe in and doing it to be able to make a fee income. And so that's, I think these are two different parts of the game. No, thank
No, I think that that's quite interesting because I also started recently and tried to build a business. I think of myself as a product manager, not just a portfolio manager, because you need clients, right? I understand where you're coming from, not being able to do the perfect, just pure trend following strategy, and that's difficult in convincing people to go on with it. But for simple things like reducing your position size to fit inside what they do, you can still take those trades, you can still take those tails. And I do think that, we also diversify across strategies as well. And that is quite helpful. So you can still maintain that type of thing. But again, it comes down to what's your idea. For me, for sure, I need to be a business to provide a service to clients. I need to manage these clients and, have something that they can allocate to, because they have other things in their portfolio as well. So how to balance those two things is a really tough question that I was asking a lot last year. I still haven't come to the perfect answer, but I think that it's really who do you want to face, and does it matter? If you are able to just do what you want because you have the capability, the capacity, and the AUM to do so, then do that, and you will find like-minded people who will want to invest in you, because that is what you do. You become that niche person. If you need to face a more general audience, then you're going to have to make some kind of concessions. How you make those concessions is up to you. Whether it's just controlling your position size, trying to look at what's the maximum, is this drawdown actually in my PPM, I cannot actually breach this level, or it's just I'm telling people that, based on our tests, that 99% chance we shouldn't hit that, but it's still open and nothing bad happens. These are all really questions that you should be answering for yourself, and then go and see if the market agrees if that's a good product or not.
Yeah, there are two types of trend followers, the ones that go for absolute returns and the ones that use it as an allocation, a call option with convexity to stock market returns. And the drawdown of trend following is controlled by the allocation. So the question is, what is an optimal allocation to trend following? On the other hand, there are the speculators that go for the absolute returns. You can judge, it's different kind of people. I bet most of the customers don't like to be invested fully in a trend following system. They need this to be part of an allocation, and as Kondura said, they are looking for drawdowns less than 10%. This is possible, but then you are looking at very small allocation to trend following that will provide the convexity when the stock market, when there is a bear market, but you are losing the absolute returns.
Again, I think it has to go back to your client, right? Yes, they are losing the absolute return in a notional number, but they may not be losing it in a proportional number, right? I mean, like proportionally to how much drawdown or how much risk you're allocating, the performance of a pure trend following system will be exactly the same. So then the question is, okay, if I put it at 10%, they can put leverage on my thing and put it up as much as they want. So actually, if they wanted the full one, they can, or you could make another product to do that. Doesn't need to be just stuck in one mode, right? So you could have multiple products or managed accounts or whatever and run them at different amounts, just doing what you do, right? So being flexible for what your potential client needs and crafting a few offerings, maybe at different leverage levels, or figuring out how they can put leverage on you, is a different question. And it still allows you to do what you want to do and then try to fit in. And absolutely 100%, no matter your drawdown or whatever, getting an allocation is super duper tough. At least in my case, I haven't found it easy. Getting 1 or 2%, I consider a win at this point.
Yeah, I mean, coming out of the Turtle program, the Turtles were just always taught that clients are problematic. They're going to steer you in the wrong direction. They're going to ask you to do things you shouldn't do, take those profits, and violate the system if necessary. And it's really a luxury to, but when you come out of that particular environment, then you're kind of not willing to compromise, or you're always trying to have it your own way. And it's so it is very limiting as it relates to building a business and trying to find clients who will just go with it the way you see it. One of the things that's interesting today is there's so much press going on with these multi-strategy firms that Point 72 and Griffin and Millennium that bring in all these traders and teach and hire them, hundreds of traders, do your own thing. We're going to put you in this big fund with everyone's doing something different, and you have these great systems, and clients get all this diversification in markets and in strategies. But when I've asked people about this, like systematic traders, and I'll say, well, do you do your trend following when you work for this firm? They're like, yes. I'm like, do you have to override the system? They're like, yes, because they're not telling us, hey, do what you want to do. You're just one of 100 or 200 traders. And if you're going to have these big swings, hey, that's you. That's what you do. That's your system. No, everyone has this tight risk budget, and a 5 or 10% drawdown is very serious. So I asked someone, like, well, what did you do in the yen trade when the yen starts rallying recently, and maybe the long-term system stays short? Did you have to get out of some yen? They're like, yeah, we have to override our system. We have to cheat. We cannot do what we want to do. We can't follow the system. We have to figure out ways to stay employed. And that's the ultimate thing. You have to staying in the game is different for everyone. And staying in the game is the highest calling. And sometimes that means doing what it takes to keep your clients and your job.
Most of these firms, they are looking for a beta neutral strategy. It's a big constraint. I don't know if you remember that firm, Quantopian. I think it was called Quantopian. They made this platform, and they had hundreds of thousands of traders around the world, many of those trend followers, some known ones too. And they try to make a market neutral strategy, and eventually they failed.
I will comment on what Absolute said quite a while ago. I got sidetracked for a while when he said something about maybe me or somebody being superhuman. I thought that was pretty funny. That may go up on my Twitter bio, superhuman. That's a really good one. I think the way I look at it is that when you do these back testing, I think that's sort of what you get from the back test, that things that are psychologically hard for humans tend to be rewarded in the back test. So I wouldn't assign any mystical powers or features if it doesn't emanate from the back test. And fine tuning and precision and exactness, these things are not rewarded from the back test. And taking the easy way out seems to me not to be, you can't take it to, you've got to rely upon the back test and maybe just comment about some of the things that it looks like work well. It certainly can inform your research projects in the future. Taking small profits. letting losses run, that's the first thing that pops out to everyone and anyone. And it only makes sense that money is going to be funneled from the many to the few.
Yeah. So yeah, I was gonna say more things when you guys started commenting on what I already said, but I forgot my train of thought now. It's like it's been 20 minutes or 30 minutes past. I'll try to complete where I was going. But my view on that is that I can see the argument that how doing the hard things and being in the minority of being able to do the hard things puts you in an advantage. However, I wouldn't go as far to make it a universal concept that doing any hard thing by default gives you an edge. So that's it's far from it that I mean, yeah, it's hard to bang my head against the wall 10 times a day, very hard, because you get dizzy and it's very hard to do it. But it's not going to put me in a small minority of people with an edge, because nobody really bangs their head against the wall 10 times a day, because it's hard. So doing the hard thing by default does not it's not sufficient to give you an edge. It may be necessary for an edge, but it's not sufficient. But I would even question whether it's necessary. And I would say, I would try to put into context the statements I heard, and we're saying, okay, it's hard, but I'm doing it. I would just put it in a context. Okay, here's an example. You have somebody with a net worth of 100 million, and he's trading a trade following strategy, which is very risky with drawdowns with an AUM of 10 million. So he's putting aside 10 million, trading the strategy. I think that even 70-80% drawdown or giving up profits or whatever would be not very stressful for this person. Like if somebody is worth 100 million and he's trading 10 million out of his 100 with whatever strategy he's trading, he's back tested, you know the edge and whatever, you let it rip. I want to compound it at 40% a year. I'm ready for 80% drawdowns, and let it rip. Doing that, this situation, it's the exact same strategy. It's different. So trading 10 million in a certain Bronco style way with big drawdowns and volatility is different from somebody whose net worth is 10 million versus somebody whose net worth is 100 million. And there's a perspective here. So the strategy on its own is not a measure of how difficult it is, but the strategy in the context of what other bets and other assets and other capital, i.e. what insurance this person has, matters. And this connects with the tweet that I had about insurance. So I would go even as far to say that it's comfortable for Jerry to look at his open profits disappear and go away because of the insurance of his closed equity, which he guards so religiously. He knows that he has the insurance of the closed equity that he does not touch and never endanger, and he nibbles at it with tiny little stops by a little bit. That's the closed equity, but that's his insurance. And keeping that capital so out of risk, so not exposed to risk, I call it insurance. He pays insurance because he keeps it unused. It sits there as insurance, providing insurance for the open trades to breed and lose pants and lose and have drawdowns and whatever. Without the insurance of the closed equity, Jerry couldn't withstand the drawdowns on the open profit. Much less if those drawdowns on open profit, if not only he didn't have closed equity, but if he didn't have any other assets outside of the strategy. No houses, no cash, no net worth, whatever. So everything is in my open profits and I'm ready to see it evaporate. I'm up 3 million in open profits. I'm ready to see it go down to zero, no problem. And that's my whole net worth. Of course, you're not going to sustain that. You're able to sustain that provided given you have insurance. So there's ways to buy yourself insurance. And by buying yourself insurance, meaning foregoing some profits, paying something. That's why when I think when Jerry says, this is the most amount of money I can make, this backtest says this is the most money I can make. I would disagree. There is a way for a certain assets under management to make more money. But the difference between the money that Jerry would make and this other strategy that can maximize the geometric return on that is because he's paying the insurance, and the insurance being keeping the closed capital sacrosanct and not risking it. So the drawdown on the capital. So this is how I try to connect the treat I said about insurance. And also what I'm just going to finish 2 minutes. Why a smooth return and small drawdown and higher Sharpe is preferable to a high drawdowns and high and low Sharpe and very volatile things. If the return to drawdown ratio is very small, or Sharpe ratio is small, let's say, I don't know, they're both 0.3 or 0.4, it may take you 10 years before you realize that your strategy stopped working and you have nothing. So you having a Sharpe of 0.3 or drawdown to return to drawdown ratio of 0.3, 0.4 or whatever. So just riding the Bronco. But you trust it. You trust in what you're doing has to be so big that you should be able to withstand 10 years of non-performance of down performance, which is possible for such low Sharpe and drawdown ratios, and you're still sticking with it. Now, I think that's hard. That's much harder than seeing your profits on an open trade given up. That's very hard, but it's hard for a reason, because your gut and your brain and your mind and whatever experience you've had from evolution or whatever is telling you, okay, forget about whether I'm making or losing money. But do I still have something? Do I still have an edge? Or am I flipping a coin that's now biased against me? That's very difficult. Now you're in the woods. So, but if you have something with a higher return to drawdown ratio or a higher Sharpe ratio, that period of unknown and uncertainty is much shorter. So, and this is why the multi-strategy funds and prop shops, I mean, I've been working for a lot of them over my career, so I know how they're operating and whatever. If you have an unknown quantity, a new trading team comes and they tell you, this is my statistics, this is what I can promise, this is what I know I can deliver in terms of return to drawdown or Sharpe or whatever, this is the only thing you have. You don't have their beliefs, their religion, their ideology. You have 200 pods like that, each of them with their own beliefs and strategies. So can you have, if you're a business or an investor or a prop shop or a multi-strategy fund, can you have 200 pods? Each of them tells you, hey, I don't really care about my return to drawdown ratio or my Sharpe ratio, but I know I have something that's statistically very significant. And if you just leave me alone, I will make you money. And I'm going to ask you, well, how much time would you need me to leave you alone? Well, about 10 years. You know, in 10 years, we'll know if I have an edge or not. Would you hire a team like that? So this is why there's a requirement for a higher edge. It's not that somebody is afraid or not. So even myself, I would accept. I would have to believe in something like to be my super religion for me to withstand with it for 10 years. So that's why the goal, at least the way I see it, is to produce as higher return to drawdown and as high Sharpe ratio as possible with as much robustness as possible. This is the optimization where we come. And I don't think that the goal is to go to maximizing robustness and forget Sharpe and drawdown ratios. Because and then just minimize, who cares about drawdown ratio or Sharpe? As long as I have robustness. Yeah, banging your head against the wall 10 times a day is very robust. But do you know you have an edge? It hurts, it's painful, nobody's doing it. And as long as I keep my head against the wall 10 times a day for 10 years, I'll probably be ahead.
And some thoughts there. Maybe I'll start with the pain and effort and doing things that require effort and maybe labor and pain endurance. I mean, I see this in all different realms of life. If you want to become a very good tennis player, it's very hard to put in 10,000 hours of work, and you may not even make it. You'll be a good tennis player, but maybe you still don't play at the Australian Open. If you want to lose weight, it's very hard to keep your fingers out of that bag of crisps because it's so tempting. If you want to be a heart surgeon, it's very hard to do all that studying. So in my life, I mean, maybe I don't have like the ultimate answer to that, but I think there is a link between things being hard, things requiring you to make an effort, to be focused, and to also endure the pain, to make it to the finish line and achieve what it is that you want. And if you want to be a good trader, and we have good trading behavior, then that comes with pain. That to me is almost like a logical thing. I wouldn't rule it out that, sometimes, and by the way, when you put in the work and all these type of things, then good things tend to happen. Maybe you become lucky by trying. But of course, there's also the other, people exist where they do have these one shots and kind of like the one hit wonders. And you also see this in trading. I'm not sure if this John Paulson guy who did the big short trade in 2008 on the mortgages, whether that's a one hit wonder or whether it was really repetitive skill, we'll never know. He stopped doing it. So sometimes it's the other way around, and that's just life. Then on the prop shops, this to me is really an interesting discussion. I thought about this a couple of times, and I had discussions with friends about this. One of them just recently, an energy trader, physical power and gas trader here in Europe, is joining a prop shop in Berlin that kind of like works like Millennium. So they have a drawdown budget, they have risk limits and value at risk-based risk limits and all these type of things to make sure that the drawdown doesn't get more than 10%, and they would probably stop the guys out if they're at 8. He would get, I think, 10% of the profits, but the capital allocation is at the discretion of the firm. And he gets paid a salary. Okay, that's great. And he can put whatever type of Bloomberg terminal or whatever equipment he wants on his desk, and that's kind of like tallied up. It's called a desk fee. And he first needs to make the desk fee before he gets a performance allocation. So I think these Millennium, all these other shops, Prelude, they probably work kind of like the same way. And so I asked myself, is this a good deal? Ask yourself if this is a good deal, because what it really requires is a very high risk-adjusted, consistent, smooth return, a lot of alpha, so that a lot of edge, like really massive edge, right? So that you don't run into this drawdown limit, you don't get stopped out, and that you can get the performance fee. And then when you have that type of edge, when you are that good a trader, and we don't have that much of an edge, we don't produce these 45-degree lines from the bottom left to the top right. We do have drawdowns, but when you're that good, then why would you trade with Millennium? I mean, why would you not just trade your own and be very quiet and not tell anybody about it and slowly but surely get rich? Or even better, if that's what you want to do, launch a fund and you have better economics because you get 20% performance fee and the management fee is kind of like your salary, but there's nobody stopping you out with drawdown limits or any of these type of things. And then finally, and then I'll stop talking, there's another model out there which I want to throw up, which is the Boothbay prelude type of, first loss piece model, which to us futures traders is really weird because essentially what they're saying is, look, you put up the first 10% of the loss. Let's say you put up collateral of 100,000 and I give you a trading level of 1 million. So that's 10 to 1. I give you another 900,000 to trade, but the first 100,000 of losses is for you to take, right? And then they have this fund with all these first loss piece managers, and they can sell that very well, and they did, to their clients, because the marketing is kind of like, hey, you have a capital guaranteed hedge fund because these managers take the first loss piece, and once they've consumed it, we stop them out. In return, you get a, say, 50% performance fee rather than the 20. But, with our futures, if you have 100,000, you shouldn't be trading that like a million. That's too much risk. But you can trade that like 250, 300,000. So you can kind of like create your own trading level. So it's really only really applicable for people that have cash instruments, very capital intensive, pre-funded, that they need to trade. And again, but the same thing applies there. Every time you have these drawdown limits, you need to have a strategy and such a big edge that whatever, Sharpe ratio 2, 3, where I think like, why would you, if you have something like that consistently, a 2 to 3 Sharpe ratio, 4 Sharpe ratio, whatever, I mean, just keep this to yourself. I don't understand why you would ever implement the code for your system or your strategy on somebody else's computer and give them the IP or trade on their book. If you have a 3 to 4 Sharpe ratio, you have to be in a position to start your own business and make a lot of money. So it confuses me to an extent that these multi-strat shops are, hiring or able to hire so many people. I mean, they're growing massively. They have massively high fees and pass-through fees and all of that. And I'm a little bit confused by that.
And I want to say very interesting thoughts, guys, today. Well, always very interesting, and today also. And I want to say that I have, to my mind, came analogy with sports. That yes, in general, hard things are good things, because in sports, first of all, you must have a good technique, and after that you must train over and over again, maybe every day, to be a champion, to be a master of the sport. Because if you have a bad technique and you train every day, it will not bring you a good result. And if you have a very best technique and you do nothing, you are inconsistent in your training, you also will not be a champion. So in our trend following strategy, first of all, we must have a good strategy, good rules, and we have it. And the second part of it, to execute it, to handle all this drawdown, to handle all this pressure. And so when we do all this, we are champions in our trading. So we have a good results, we're rewarded by the markets. So, and of course, if we have bad rules and we follow bad rules, it's not a good idea, I think. Here's my point.
Moritz, can I ask you something? Even if you have such a huge, let's say, Sharpe ratio or whatever risk-adjusted return, doesn't the starting capital of the manager, if it's too small for his living expenses or his living tastes, so to speak, require that they have to get money for somebody else?
Yes, I think so. I mean, if you say you have a 3 or 4 Sharpe ratio in futures because you're trading very short term and you've just found something that works, which we're all unaware of, have a look, for instance, at fundseeder.com. Maybe you know this platform. You can log on. I mean, these are traders like us who submit their trade results to fundseeder.com, and they are audited like from their trader workstation, from Interactive Brokers, or from their Charles Schwab account. And there are a bunch of people on there that have these returns. They're not working for Millennium. They're trading their own book, and they're trading futures or stocks on Interactive Brokers. So this is, I followed some of them. Occasionally, I give this a look just because I'm interested. And some of these accounts, started with, 150 to 200,000 dollars, and they've grown into the millions. I mean, so it is possible. Or you need to raise a little bit of money from someone to support you. But I just struggle to understand why people with Sharpe ratios of 3, 4, like these amazing things, which apparently do exist, why they would go to Millennium and kind of like download their skill and edge to somebody else for what's essentially a worse deal. Yeah, they pay you a salary, and again, they have the pain, right? Go through the pain of not having that salary, and maybe fight a little for a year or two, and try to make it to work on your terms, so that nobody can interfere with the way you trade or kick you out when you are in a drawdown, so that you need to violate your system. And the first loss piece type of stuff is even more weird. So, yeah.
And another thing about the trend following that I do, the old caveman, is with the trade levels and the 1 entry, 1 exit, and a stop loss, is at some point in time, after the first few months or 6 months, the equity that was initially put in is no longer at risk. Historically, every day for the past 30 or 40 years in the back test, this style, the original capital has never, the value of the account has never gone below the original capital. So, maybe a new style or way of getting money would be, give me 6 months, I'll give half your money back, and then after another 6 months or a year, I'll give you all your money back. And so then we'll continue trading at the same notional level, but you've got all your money back. And that is very doable historically with this strategy. And then to comment on what Absolute was saying, just one thing you mentioned. I think, putting all these people together, you can certainly expect to let them do their own thing and have their drawdowns and follow their system. There needs to, if I was running one of these firms, it would only be systematic traders, and I would get into the code and understand what they're doing, and tell them that they need to correct some things, or their allocation is going to be limited based upon things they refuse to take out of their system. I'm going to know ahead of time, and I'm going to evaluate ahead of time, not wondering in the future when they start losing money. And I'm going to try to find different strategies, different ways of doing things. And so, to the degree you're successful in doing that, to where you really have meaningful diversification amongst these hundreds of traders that you're hiring, that's the degree to which you can let them do their thing and have these drawdowns, because you really do have this true diversification of markets and managers and strategies and styles. But of course, I would never hire a discretionary manager who didn't have at least a systematic plan. I used to sit in front of a computer and quote machine and follow my rules by looking at a chart book. So that's okay if you don't want to code it up, but I have a list of your rules and you're promising to follow your rules, and then I'm evaluating you to make sure you're actually doing that, and that's fine as well.
One problem with these compendiums for thousands of traders is that at T equals 0, you never know which ones will make money. So if you select like 10, 20 of those, there is high probability at the end of your investment horizon you will not be making any money.
Just a quick question. You mentioned, Moritz, the Sharpe ratio of 3 to 4. What would be the equivalent MAR ratio, by any chance, so that I can imagine it on my mind? Thanks.
I don't know. I don't remember that, but they really go into fundzero.com. They have a ranking. Have a look at the top 10 of these people, and they're essentially like almost linear type of lines. I mean, a little bit of volatility, but very smooth. Now, I'm not saying that
what we don't know is exactly how they trade. They just show up in this league table. So you can sell out of the money puts for a number of years and be lucky and be the number one person on that league table. They give some details, and there's some people out there that say, yeah, look, we're trading futures long and short, and it's intraday and whatever, and hourly bars and that type of stuff. So that suggests, unless they're untruthful, that they're not selling out of the money puts and out of the money calls to just collect premium, and they have these very high Sharpe ratios and very, very little drawdown. I guess Millennium is calling them because they want their business. I'm not sure if it's scalable, but if you're that good a trader, if you have that edge, if you have found this thing that works, and it's really a system, and it's like us with sample size, and if they found something that is so great, then don't go to Millennium. You'll find a way to create your own business or just trade your own money and become wealthy that way.
Yeah, I remember all these forex traders. They were arbitraging the Swiss franc peg to the euro, and they were having a Sharpe ratio of maybe 6, 7, 8, up to 10, and they lost everything in one day, like 8 years ago. All these small edges, they disappear suddenly with catastrophic losses. The small edges. The only true edge is discipline. Like Jerry saying, entry, exit, stop loss. All the small edges, they are opportunistic and they disappear in like an hour, like what happened with the Swiss franc peg. Or the XIV, many of you remember the short volatility, and in one day they were all broke. They thought they were printing money.
Yes, I agree. And by the way, I think there's reason, and this is just my personal opinion, so reasonable people may differ, but I think there's reason, at least for me, to be somewhat scared of Sharpe ratios greater than 1, certainly greater than 2, 3, 4, 5, 6, because usually there is some risk there, there's some tail, there's something that they're warehousing, there's something in that process where they're facing a counterparty that may pop up. That's kind of like where they're making the money. They present it in a different way. And we've just seen this again in the digital asset markets with, there's now 1,500, believe it or not, digital asset hedge funds. A lot of them have started in just at the end of the bull market 13, 14 months ago. Bad timing. But, these markets and these tokens and coins, it's all over the place, all these different trading venues, different jurisdictions, no clear regulation, all these unregulated offshore, essentially broker-dealer funding, trading venues such as FTX, lending places, Genesis. Of course, it's kind of like fireworks, right? It all pops up on a computer screen. You can arbitrage this and do that, and long short here and basis trade there. And some of these trades are fantastic. I've written about doing this basis trade in Bitcoin, but on the CME, not on FTX. And, they do multi-strat right away. They pivot into multi-strat right away because they realize that there's so much diversification in doing steepness and flatness, and now there's a volatility market that you can arbitrage. It's really attractive. They're competing in this niche where there's rather than competing for half a basis point on the S&P 500 vol surface against all these PhDs from Goldman, here they're competing against these crypto kitties, and they're making money left, right, and center. But it's also the naivete in that space where they don't really understand, and they don't have a feeling, and they don't have knowledge of risk, I think. Or I think, reason to be suspicious. They don't have a good trading education or kind of like a TradFi background, and they just came to this crypto land and they think it's completely normal to be paid 20% interest because you're lending some coin to whatever type of AWS server IP address that happens to run the trading book. And they, fail to think one step forward where that could go wrong. And that produces a 6 Sharpe ratio. And that's very attractive for the outside observer. that maybe fails to look through this and then invests and then they lose their money. And my suspicion is that good, not my, no, I take that back. It's not my suspicion, it's my conviction that good, solid, well-designed, robust, resilient trading strategies don't have Sharpe ratios of greater than 1. I think 1 is whatever the number is, but it's kind of like around there. But that's the cap, that's the boundary. If it's higher than that, it's possible. Look at some of the guys at Fundseeder. Let's see what happens with them. But I'm not ruling it out. That's kind of like an impossibility. But I think from what I have observed, and maybe you as well, in all these years, the good stuff that sticks around, that doesn't make it to the front page because of a blow up, it's kind of like there all the time. Not all the time working, but it's not going away. Refuses to die. Doesn't have a Sharpe ratio of more than 1.
I agree 100% with you. Very, very good insight. Yes, these edges exist. They are, most of the time, they are microstructure, market microstructure edges that disappear suddenly. And then there are catastrophic losses. And some of these traders, they end up having to sell their homes to cover the margin calls. This is what happened with the Swiss franc peg, by the way, or the XIV collapse, 99% in one day, I believe. So yes, these edges exist, but they are not the typical edge we are talking about here of trend following, one exit, one entry, one exit, stop loss, trade many markets, look for outliers. They are opportunistic edges, and the lucky ones that are smart to take the money and run at the right time, they may survive, but most of them, they don't. 99%, I believe, my opinion, of those speculators, they end up owing money to those who finance them.
I wanted to comment on Absolute. I think it's the way I kind of approach it is that I'm like trying to get this edge. I want to create this portfolio super safe. Going to be very conservative on my money management, my leverage. Follow the back test that's telling me the look back and the time frame I should be targeting. I'm just not going to solve for Sharpe or drawdown or MAR. I'm not solving for it. I am solving for risk of ruin and massive diversification and small bet size and reasonable leverage and looking at the equity curve, the backtest equity curve, and thinking things could be a lot worse than that. And erring on the side of one entry, one exit, and a stop loss, and trying not to add more than that. And then with an eye towards I can't really predict if the future is going to be way worse than the back test. And then after I'm done, my Sharpe is okay. Or my MAR is okay. My return and drawdown, they're okay. I didn't target that. I wasn't trying to maximize that like some silly quant. But in doing all that I can that's sort of using my common sense to minimize, to be able to stay in the game and to minimize my risk of ruin, whatever that ruin number would be, a certain drawdown or losing half my money, then I look at those ratios and say, okay. And then I'm wondering, are all of these Sharpes and Mars, are they created equal? Can you take two people with a Sharpe of 0.5 or with a return drawdown, the drawdown that's twice as large as the average return? Are those always created equal? Can you dig inside of that code and those systems and say, oh, wait a second, I really prefer one over the other, although the numbers are kind of identical. And so that's what I'm getting at. I think, okay, let's dig a lot deeper than superficially running a back test and maximizing some of these ratios. Do these ratios, I'm asking myself, do they even give me they have to correlate to risk of ruin? Does Sharp give me a good indication of that I'm going to really have problems preserving capital and staying in the game? Now, a few months ago, the other Bruno said yes, and they do. Sharp does that. But to paraphrase him, only if you are using current AUM as your trade level and not using what some of the rest of us use, which is closed trade equity or a number that doesn't fluctuate often and something that's sort of based on the closed trade equity. He said, yes, that is much different. Sharp does not translate. So I think these are the questions you need to ask rather than running that back test and getting that big number out and saying full speed ahead.
Yeah, I agreed with what everybody said. I just wanted to say, I hope I'm not. You don't think I'm on the opposite side arguing the opposite. So I agreed with everything that was said here. I also agree with Moritz that Sharp of one is kind of the both Sharp and Mar return to drawdown ratio around or close below one. I think it's the sweet spot of performance and robustness. But there's a huge big space between Sharp and return drawdown ratio of 0.4 to 1. So there's for people who say they don't care what the Sharp it is, I'm assuming they would accept 0.4, 0.3. And I'm saying 0.4 and 0.3, it's problematic because at those levels of return to drawdown and return to volatility, it will take 10 plus years before you have some statistical realization that you have what you thought you have or not. So basically the uncertainty, it's not the drawdowns that would make it psychologically difficult for me. For me, what will be difficult is not knowing, even after 3 years of flat or down or some kind of performance, whether I still don't have enough statistics to know with any level of certainty, with certainty higher than 70%, that I do have something with Sharp 0.4. Now, if I have been running this for 30 years, let's say I've been experienced like Jerry or whatever, and I've been doing it, and yeah, I've had this 0.4, 0.3 return to drawdown Sharp, then I know it's there. Then if after 3 years, I'm not going to question it. But even then, you may have had a real statistical edge of value 0.4, let's say, for 30 years. But then again, it's going to take a long time before the market steals that edge away from you and you find out about it. So let's say you've done 30 years, 0.4, you know you had an edge, you've proven to yourself and to your clients and to your investors and to everybody that you do have a provable 0.4, Sharp or return to drawdown ratio. By the way, to answer the question, I don't know who answered, usually if, in my experience, the return to drawdown ratios are very similar to Sharp ratios, at least on the strategies that I've tested and I've run. They're very similar. They're always similar. So like Sharp 1 would probably be return to drawdown of 1 or close to 1 or plus minus 10 or 20% of that. So they're very similar if you have something consistent. So the problem is, even if for somebody who really had a Sharp and a return to drawdown ratio, is that Mar? I think that's Mar, of 0.4 for 30 years, proven, so robust. Even for that, you never know that from this point on, let's assume yesterday the market stole your edge. The market's changed slowly over the last year, over 2 years. It took away your edge of 30 years, whether it's the time frames, whether it's the stop losses, the distance, the whatever. You thought you had it, and now the market slowly stole it away from you. Now your actual Sharp is 0 or -2 drawdown ratio. It's going to take you 5 years before you find out. And that's what will be difficult for me. Like not knowing that, am I in year 3 of finding out that I don't have the edge? What is the likelihood that my edge disappeared 3 years ago and I'm in year 3 after it disappeared, still trading it? Look, it's behaving. I'm in a drawdown, slow period, whatever. If I've been there before, so it can happen. I'm normal. I'm okay. Now year 4 comes. And so I had this question to Jerry maybe 2-3 weeks ago or a month. So with strategy, if you don't care about return to risk or return to volatility, how do you deal with periods of such uncertainty? That to me would be the biggest painful thing, that I would never know. I'll be in the darkness, like in the dark room and just trying to find the walls. That would be the uncertainty.
I mean,
That's why I would try to
just,
gravitate closer to sharp of 1 rather than 0.4.
just a quick thing. We all have huge, in trend following space. The track record is there, right? Is historically this is the single most known strategy with the longest track record. So if you read some of the books, some of the books say that the track record goes back to 800 years, like Alex Grayserman's work, for instance. So I don't think that we do have a lot of convincing in what we do. We just need to run it. It's just sometimes difficult to run it. That's all. Thanks.
But that's not true. That's not you. It has been running, but not for all parameters, not all lengths. Like if you're doing 20-day breakouts like Turtles did, okay, with a sharp of 0.4, let's say, I'm sure the sharp was higher with shorter term, and the edge was much higher than if you're trading 20-day or 10-day breakouts when the money was good. I'm sure the sharp was maybe 1.5 or even 2 for those people. With those high sharps, it's quick for you to discover that after 1 year or 2 years, that's it, your edge is gone. I used to have a nice little curve that goes up with a sharp of 1 or 2, but the last 2 or 3 years is gone. 4 years, definitely. Like if I'm flat, if I had a sharp of 1.5 and I'm flat for 4 years or down for 4 years, that thing is gone. And provably so. It shows that after the 90s, whatever, trading 20-day or 10-day breakouts, it's just flat. It just treads water and it loses money. You just pay transaction costs. So
yes, but I mean, trend following is here.
Well,
Yeah,
okay.
you just need to
No, but
change your
systematic
parameters set.
trading is
Yeah.
here. Trend following has all sorts of. You know how huge the parameter space is for trend following? Trend following will always be here. Your set of rules and stop losses and exits and whatever, it's not guaranteed to be here 10 years from now. And if your set of rules and parameters has sharp of 0.4 or lower or low, it's going to take you 10 years to find that out.
Yeah, but so what we do is, Richard usually fleshes out better, but every year we add the recent data into our data set and refresh our, models with the latest data. And if any tweaks needs to be done, it is done. So I'm sure everyone else is, adding this new data set and re-questioning the parameter set that they are running. And also, the long-term models, in my humble view, has an edge in the sense that it is psychologically difficult to run those. Everyone would like to, do the trend following on the intraday, like hour the bars. But when it comes to doing it on the long term, it is very difficult to do that. So there is an inherent edge on the long term systems that and so I do not know any parameter set that actually was running and stopped running with the long term systems. What you have described is a short-term system phenomenon where 20-day breakouts were working at some point in 1980s, but it is no longer working, which I understand. But because the long-term system, your average trade duration is 1 year or more, and it is really hard for a lot of people to endure that. So, and so this is one point. The second is, trend following is here. Many people around the history has, run this strategy. So if your parameter set stops working, your job is to ensure that you find something else that works, or you're just going to stick to the long term, which the situation that you have described hasn't happened yet. Thanks.
That's right. And thankfully, during that period that I did change my systems in the late 90s from those short-term parameters to long-term. And the good thing about it was that when we did the back test using the long-term parameters, those longer-term systems worked just as well or better than the short-term. So the whole time we were trading short-term, we could have traded longer-term as well and done just as well. But I think to answer your question, I mean, I've said many times before that these you're using as much data as you can, all the data, and not only that, but you're admittedly going out to these longer-term parameters, so your sample size is lower than it was when you were trading the shorter-term parameters, and so you'll be the last person to. You insinuate, because you know more about math than me, so I'm not questioning it, that there is a certain amount of time, this 10-year span, where you'll definitely know what the deal is. Well, I'd probably just keep looking at the past 30 or 40 or 50 years worth of data, and I would definitely see the trail off of performance, the recent trail off in performance, but I'd probably still keep using it. So I'll be the last person on the planet who will be able to come up and say, oh, I haven't made money for 10 years. Now, admittedly, we're coming off the 3 best years I've ever lived in trend following, so I'm not too concerned about this. But we could easily revert back to that. Everybody wants to blame it on the Fed, and now that the Fed has changed, now we're clear sailing again. That's not necessarily the case. We'll have to wait and see. But certainly the classic trend followers who want to look at all the data, not just recent data, may never change, and they'll just be sitting there. I'll just be sitting there losing money and breaking even, losing to the commissions and the fees and wasting my time. And maybe, a last-ditch effort would be to extend the parameters again. So it's almost like buy and hold. So I don't think that I don't have an answer. That's the problem. I would need to consult smarter people to tell me, oh, don't look at all the data. Look at the last 5 or 10 years. And I think that's what you're saying. All right, it's been great. I need to run. We can pick it up on Twitter or pick it up next week in the ideologue space. I hope everyone has a good weekend. Thank you.